Right, hello everybody. Welcome to today's Trend Signal podcast. It's the 21st of August 2023. My name is Adrian Boovey. I'm head of trading here at Trend Signal, and as ever, I'm joined by our chief analyst, Jerry Miller. Hi, Jerry.
Yeah, hi. Morning to you, Adrian. Morning all.
So quite a bit's been going on over the last few days. Seems a bit of a surge in bond yields. China having a bit of a rate cut over the last few hours, really. So it's certainly made for some interesting movement on the markets over the last week. So what we're going to be doing today is taking a look at what's happened in the markets over the last week, what we've got to look forward to for the week ahead, and then I'm going to dive into the charts themselves, have a look at some of the opportunities that have been kicking around as well. So Jerry, why don't you take us through a bit about the backdrop? What do we know? What have we seen over the last few days? And what do traders really need to be aware of?
Yeah, it's that sort of holiday season at the moment, and a number of sort of commentators put some of the moves down to the markets being a little bit thin as a lot of the key participants are on their beaches in Europe and the US, but it's a main vacation month, obviously. But I think it's a little more serious. Well, it's a little more serious. It's a little more relevant than that. I think what we've seen over the last week is quite an interesting split again between China and the US and the Western developed economies. We talked last week or the week before about how inflationary expectations have diverged between China and the US, with China almost entering a brief period of deflation, whilst obviously the West is tackling inflation. But what happened last week was quite interesting. Again, contrasting news, but we had the Chinese economy really publishing some pretty dire data, and also the People's Bank of China, or PBOC as it's called, actually injecting liquidity. And what that does, it's designed to try and bolster the renminbi or the yuan, the national currency, and really help consumer sentiment. So you've got that worrying the global sort of growth argument, in that China is responsible for global growth, really. No other economy has done more than in the last 30 years to underpin global growth. But if you pull that away, then you really are reliant on the West, and in particular the US. And the US had its own little problems last week, with some stronger than expected data, number one. Number two, we had something called the FOMC minutes. And what that is, Adrian, it's the Federal Open Market Committee, a bit like our MPC, but it's the Federal Reserve's rate setting committee. And rather curiously, I think we do it correctly here in the UK. We release our news from the Monetary Policy Committee at the Bank of England, and we release the minutes all at the same time. But why wouldn't you? But for some reason, it takes the US FOMC 2 weeks to type out their minutes. Anyway, what they said was that there was still significant upside risk to inflation. But that's sort of what they've been saying, but the market wasn't really listening to them, at least wasn't listening to Jay Powell when he had his press conference a couple of weeks ago. And what that's done is that there's been a big sort of jump in bond yields last week from that time in midweek. So if you look at the S&P 500 from middle of last week, you got certainly Tuesday, Wednesday, Thursday, it was pretty dire. The market, I mean, I call that a big slump, and it really was a big slump. I think in the end, markets closed down. Well, the S&P closed down sort of just over 2%, with the Nasdaq down, as you'd expect, quite a lot more, down about 2.6, 2.7%. And these are big weekly moves. There's no denying it, and those markets are fretting over the jump in bond yields, which is what you referred to earlier. Why are the bond yields jumping? Well, if inflation is going to remain, it's not going to hit target, and that's going to result in the Federal Reserve not only not cutting rates this year, but there's still a 1 in 3 risk or chance that they could raise rates again this year. And it was notable, if you can open up the FedWatch tool, Adrian, we can have a quick look at how that's affected the markets. If you look at, certainly through, so if you look at November, the probability of a cut, it's a bit more. It's jumped this morning again a little bit more, so it's there's a greater probability than 1 in 3. But it's still, if you click on December, you'll see that it's roughly the same again, or a little bit lower. Yeah. So it's still odds on that we're going to keep rates at 5.25 to 5.5%. But what the market had been expecting was some kind of cut by March. If you click on March 24, that's the one. So now we don't really have a rate cut there. So you've got 41.6% probability of staying at that, but there's a 15.5% probability of it going up. So added together, there's a good 56% probability or 57% probability of rates remaining at 5.25 to 5.5%. Whereas a month ago, it was, there was a chance that we're going to see a cut.
Yeah, it seems like everything's been pushed back a little bit. You're still talking by the end of next year of, lower rates. The most likely what they're being priced in is, 1% cut. But I guess they're probably expecting that a little bit earlier in the year rather than what's being priced in now. Is that basically what we're saying?
Yeah. And it's interesting that, we go through this in these podcasts and we talk about what the market's thinking versus what the Federal Reserve are thinking. And the Federal Reserve have been noticeably more hawkish. Certainly Jay Powell has. I mean, there have been members of the MPC who at the last meeting said that they didn't think there was a need for further rate hikes. But further rate hikes is one thing, but cuts in rates is another. And all of a sudden, the market is now thinking, hang on, I thought we were going to get rate cuts. We've factored in rate cuts. And that's what really helps the tech sector, that's still growing its revenues. And it's very dependent on the cost of funding. And all of a sudden, that rug gets pulled a little bit and a little bit more. And it was a big move Friday with bond yields jumping the way they did. And it really reflects the fact that inflation is going to be a bit more stubborn than markets were hoping. And the interest rates are not going to come down as markets were hoping. But the Federal Reserve and Jay Powell have always said, we think rates are going to remain elevated for longer. So it's really the markets coming more in line with what the Fed have been saying with their comments, and also with the dot plot that the members indicate where they think rates will be every quarter for the next couple of years.
So one thing with this, I mean, one thing we will say, particularly with currencies, it's a lot easier to work out where a currency might go if interest rates are more likely to rise in that particular currency. So, if that's happening, interest rates more, it generally leads to an increase in the price. So pound would go up if suddenly, UK interest rates are more likely to rise and so on. It's a little more nuanced with stocks, isn't it? So how would it sort of operate? So what we're talking about here is interest rates may sort of hold up a little bit more than we thought and stocks have fallen. Is that always the case, or is there a little bit more to it than that?
That is the case. I mean, but you use that word nuance. Sometimes stocks are more sensitive to certain bits of information, and that sensitivity changes from week to week. If the market was convinced pretty much that the Fed had done raising rates and were expecting rate cuts, to suddenly find out that this comment about significant upside risk to inflation and the fact that it seems now that the Fed are going to get their way and keep rates higher for longer than the market was hoping, that's not good for stocks. And remember, the way we price shares is not what we think they're worth now. It's what we think they're going to be worth in 15 months time. So the market had extrapolated the fact that the Fed were going to stop raising rates, the fact that the Fed was going to be cutting rates, and all of a sudden the garden smelled lovely, and the roses were out blooming and everything else was fine. But that's not what's actually happening. And I think it's that realization. It's really what I would call a re-rating of risk. A risk that the Fed don't cut rates.
So the concern for shareholders and companies really is, I guess, that actually if they're not cutting rates for for so long, it's going to say the cost of their borrowing, as you say, is going to be higher, which basically means they're not going to be as profitable. Is that quite an easy way to think about it?
Yeah, it is. Yeah. Rates are remaining elevated for longer. It's like it's what's going to happen here in the UK. It hit UK bond yields as well, this big move up in bond yields, with our yields jumping the highest they've been for quite some time, certainly higher than when Liz Truss was causing problems.
Yeah, yeah. Okay, so a couple other things I noticed. I mean, obviously the FTSE was weaker last week than the US indices. Certainly the Nikkei was. The Hang Seng, probably the biggest fall of the main indices that we look at, down around 5.9% on the week. What's the story there? So why are those indices moving more than the US ones?
Yeah, I mean, I think the FTSE is a little bit susceptible to what's happening in China, and the news out of China is really quite worrying for the global economy, and also quite worrying for the Chinese economy as it transitions from a manufacturing to a consuming economy, and they've just got such a poorly performing property sector and house building sector, which is saddled with massive debts that can't be repaid. The biggest private house building company really struggling, missed 2 of its payments last week. You've heard of Evergrande. This is a sector that's responsible for up to 1/3 of Chinese GDP that is absolutely kiboshed. And the worst, I suppose, in a way, what the People's Bank of China doesn't want to do is to make the situation even worse. And they were supposed to cut both the 1-year and 5-year loan rates today, but they only cut the 1-year loan rate. The 5-year loan rate is really what is measured against what people, borrow money for when they're purchasing a property. So you can see perhaps what the PBOC are looking to do, but China is not in a good place, and it's not helping the FTSE. And we slumped right down to support last week, which back down to those levels in
250 level, yeah.
In early July. I thought we'd sort of recovered. I still think the UK economy seems to be performing better than virtually all economists were expecting. And another economy that's been hit hard by China is Germany. And I find it really interesting the way that Germany is struggling and struggling a lot. And there's an interesting article in The Economist referring to Germany as the sick man of Europe again. And it's a headline that The Economist put out 25 years ago after a unification. But Germany is expected to have slower growth over the next 5 years than the likes of the US, Britain, Spain, Italy.
Why would that be?
Well, because of its dependence on China. It's one of its biggest export market. The Mercedes and BMWs and VWs driving around China. That story has become a lot more challenging for Germany now.
It's interesting, isn't it? You sort of, I don't know a huge amount about some of these things, but you think about the situation with Ukraine and Germany's reliance on, Russian oil. Was a big thing. It seems like they're very focused on the sort of the global market, far less so than perhaps they should be focused on their own. And maybe that's wrong. Maybe I don't know enough about it. But
I think you can't blame them for exporting the way they have.
There's opportunities out there, isn't there? And if they're not going to, then someone else is going to, which then leaves them behind.
But but it's like a business. If a business has one avenue for it or a significant avenue for its products, and that avenue suddenly starts to sour a lot. There's no other places that Germany can sell its cars, for example, where it's already selling a ton of cars anyway. So it's difficult to know what the solution is for Germany, but the numbers have been particularly bad, and we've got this manufacturing PMI data out, well, services and manufacturing data out tomorrow, and Germany's manufacturing data is expected to remain so weak, and that's because of what's happening in China.
Well, why don't we have a look at that? We've got some economic events for the week ahead. So these are things that are going to impact the currency markets, the index markets for the coming week. We've already talked about China's interest rates overnight. So let's have a look at the economic calendar. Let's see what the main events are setting up, Jerry. So do you want to just take us through what we want to be looking at here?
Yeah, as you can see, we've already had the loan rate news from China. We've got the BRICS summit tomorrow. That's Tuesday, the 22nd, just to make sure if you're listening to this after this. But BRICS, that stands for Brazil, Russia, India, China, and South Africa. It's a phrase or a mnemonic. I think it was Jim O'Neill at Goldman Sachs who first coined the phrase, or the mnemonic of BRICS, and they're meeting in Johannesburg with all the leaders of all the countries involved, apart from Russia. Mr. Putin is not able to go because if he does attend it in South Africa, he'll be arrested on this international arrest warrant. Not going to necessarily change much there, but it's a group that's looking to expand its membership and its influence, and it's designed to try and counteract the dominance of the G7, which is regarded by a lot of people as being very Western orientated and rather selective, which of course it is. And the BRICS have always said that they want to de-dollarize the global economy and not have it reliant so much on dollars. I mean, the main reason why is because the US uses its dollar transactions as a weapon to punish countries that step out of line. And it's potentially going to attract a right sort of group of, the not so nice economies that flout a lot of laws and are involved in a lot of underhand goings on. Anyway, I think it's unlikely that they're going to expand much. And I know that India, which is a key sort of member of the BRICS group, has said that they're absolutely against creating a political body that could start lobbying on behalf of the group. So I think it will be won't achieve too much, really.
Okay. Wednesday, you referred to the PMI data for the likes of Germany. That's quite a bit going out in the mornings on Wednesday, isn't it?
Yeah, we basically got the Eurozone, which obviously includes Germany, but they actually combine it in what's called the flash manufacturing and flash services one for the Eurozone as a whole. It just doesn't make good reading, Adrian. The manufacturing sectors are continuing to struggle. Anyone who's listened to this podcast will know that, we mentioned it numerous times, that the manufacturing sector is the one that is burdened by the significant rise in interest rates that have happened for all these Western economies, because it adds to the massive cost of financing manufacturing operations. And some of them are just way down. I mean, you're looking at Germany there, 38.6. You wouldn't think it could go much lower than 38.8, but it was only sort of really the pandemic start that really kiboshed it. It was already pretty weak anyway. But if it goes below that, I'd be gobsmacked. But it just shows you how dire things are in Germany and in generally in the Eurozone, like they are in the UK, really. I mean, our own data, when you look just a couple of rows lower down, 45.1, that is significantly below the all-important 50 level, and it's been below it for a year, longer.
Yeah. It's not quite as aggressively downtrending though, is it, as Germany? That's for sure, but not where we need it to be. That's for certain.
No, and our manufacturing sector is a lot smaller than the German manufacturing sector. We're something like 81 or 82% services sector based, and for that reason, actually, that's one of the reasons why our growth forecasts are better than Germany over the next 5 years, because we're not so reliant on manufacturing. I mean, some might say it's a massive shame, but that's the fact behind that.
Okay, we've got, let's go, anything else that we need to be aware of? Durable goods, I guess 1:30 Thursday, if you're day trading, say the dollar, or maybe the S&Ps, the Dow, you want to be aware about that. That's a relatively important number. Anything else though, Jerry?
Yeah, really, other than that, it's really the FOMC members that are talking. And we've got this Jackson Hole symposium that starts on Thursday. Jackson is in Wyoming. It's called Jackson Hole because it's originally trappers found it difficult to get out of Jackson in the winter because it was surrounded by mountains, and that's why it got referred to as a hole, really. But anyway, it's a collection of central bankers and finance ministers that meet They don't include the press, so nothing much gets out immediately, but it does get out. And for example, we've got before the meeting, before the Jackson Hole, we've got this member Harker who's speaking on CNBC on Thursday about the economic outlook. Why are we interested in that is most of you probably never heard of Harker, one of the FOMC members, but the fact that he's talking about the economic outlook and the fact that he actually is from the FOMC, from the rate setting committee, I think is fascinating, and it'll be interesting to hear what his comments might be about the spike in yields that we witnessed last week, and what's happening in China and how that affects what the Fed is thinking. So that'll be key. In fact, this chap Harker's talking again on Friday as well. He's talking twice. I think he's on Bloomberg and Yahoo Finance. And then we've got the revision to the University of Michigan's consumer sentiment. I've never known a revision change the flash number. So I probably would not spend too much time thinking about that. But then we've got the second day of Jackson Hole, and again, behind closed doors, but Jay Powell will be speaking about the economy, and so will Christine Lagarde from the European Central Bank. So that information, Lagarde speaking really towards the close on Friday evening. So what effect it will have, not sure. Certainly Jay Powell's comments will be seized upon if he says anything about the outlook for interest rates in the US.
Yeah, I mean, I guess he's not going to, perhaps give all the picture away from their discussions, but he's not going to be talking at complete odds with what they're discussing at Jackson Hole, is it? So you're going to certainly get some clues.
That's him talking at Jackson Hole.
Yeah. So there's a few bits there, and I think some of these things, how are they going to affect us as shorter term traders? These things create movement. Movement creates opportunity, whether that's for day traders or for swing traders. So certainly be aware of some of these things, and certainly be aware that it's going to create opportunities and potential turning points in the market, because those turning points that we can absolutely get behind. That's great. Thank you, Jerry. We'll leave that bit there. What I'm going to do is jump on to the charts now, just have a look at a few of the opportunities that have been kicking around over the last week. I do want to start off by looking at the indices, particularly the FTSE. Jerry mentioned coming back down to support. It is absolutely, and as is the DAX as well. So a number of these markets coming back down to those sort of early mid-June July lows. That number 72.52, the major support level from which we bounced. We tried to nudge a little bit below it on Friday of last week. Price is then rallying back above that pivot point there. So these dotted lines, very, very important for the market. So nice to see us stay above there. It'll be interesting to see where we react to from here. Could be that we'll get a bit of a lift. Could be a buying opportunity comes over the next day or three. But really interesting level of support there. As you can compress the chart up, you can actually see us nudging down to those levels again back in March. That's 3 times we've been defending the 72.50 level. Will it hold prices again? We will find out, but it's certainly an interesting zone at this point. Let's have a think about the trades over the last week. So trades from the 14th of August. So we've had what about sort of 10 or 12 trades here for what we call the D1 sniper strategy. Overall, based on risking 2% of your account on each trade, up 6.3% net. So winners minus losers, 6.3% up. The D1 accelerator, up 2.6% on the week. So some interesting opportunities there. Overall, up 8.9%. So what does that mean to you? Well, if you've got £1,000 account, you're up what, sort of 89 quid or so. Which is good, great return, really. Let's have a look at those opportunities. It wasn't without losers. In fact, we start off with one from Monday of last week. So we had a short trade there on the euro against the Canadian dollar. Another one setting up, another buy trade setting up for tonight, actually. But short trade there, never really got out of the blocks from Monday night. Reversed really on a sixpence straight away and knocked out for a loss, 49.8 pips. On the back of that nice buy trade from the 3rd of August. So chopping around a little bit there. So be it. That's what the stop loss is for, and very much sort of directionless really over the last 2 weeks or 3 weeks there. An interesting buying opportunity. It'd be nice to see the price give a bit more of a lift, so a nice convincing buy bar there. We'll be looking out for that tonight. What you don't really want, because at the moment it's sort of trying to go up, coming back down, trying to go up, coming back down, trying to go up, coming back down. A more definitive, convincing buy would be attractive. So we'll see where we are for this evening. At this point, stop loss only 27 pips. That is below our minimum threshold. We require for the D1 Sniper on forex trades stop losses of a minimum of 40 pips. If they are less than 40 pips, they are a no trade. So we've had a few of those in August. And the reason why they're no trades is because, or invalid trades should we say, is because typically, unless that trade's got a bit of room to breathe, a bit of maneuvering, a little bit of slack there, if you like, they tend to be bad trades. You know, you need that ebb and flow. You need the ability for the price to come back against you a little bit in order to carry on to target. And if that stop is too tight, there's not enough movement there, not enough freedom on the entry, it can lead to inferior trading opportunities. So minimum of 40 at this point, looking like an invalid opportunity, but we shall very much see. So EuroCAD, there we are. That was a loss out of the gate for us. Euro sterling, we then go through to I think Tuesday night, the 15th of August. We had quite a few trades trigger there. I think it was 7 or 8 trades come through on the 15th of August, all of them going through and hitting our starter target. That's the first target that we look for on those opportunities. Typically a nice bite-sized target, high probability opportunity, and where we expect, based on data, kind of like the sweet spot, the most likely scenario for that trade. So in the case of euro against the pound, there was the short there from the 15th of August. The objective, the target, was 30 pips there. Now, obviously, as you become more experienced, you can extend those targets out to perhaps previous resistance levels and so on. And we teach our members how to do that. Otherwise, from the outset, new members focusing very much on the starter targets. This particular opportunity, a 30 pip winner, giving us a 1.3% profit on that trade. So £1,000 account. It's only 13 quid, but it's 13 quid we didn't have. And again, it's all relative as your account grows. If you had a 10 grand account, that'd be 130 quid profit on that trading opportunity there. Pound against the Canadian dollar. A really interesting buy trade again here, 15th of August. And again, it's really important to have a look at some of those. A couple of choppier trades, the short trades there on pound CAD, not going so well. But what's the common factor on these two shorts? Let's click on this one first of all. Stop loss 9 pips away. It is far too narrow. It is likely to result in a loss-making trade. Therefore, this is an invalid opportunity because it is less than 40 pips, right? We need that minimum threshold to give us an attractive enough trading opportunity. Again, equally, from the 2nd of August, 36.9 pips. Again, an invalid trade. This one, a nice opportunity and a nice winner. This one, there from the 15th of August, a nice opportunity, a nice winner. So nice 1.2% profit on pound against the Canadian dollar. The DAX, we talked about this as an opportunity. There was a short from the 15th of August, again hitting target on that second day on Thursday. Yes, it has overshot a little bit more, but remember those starter targets that we call them here on the chart, 79 pips in this example, is based on pure data. Let's have a look at this market. Let's have a look at this type of technical analysis scenario. How far does that market type of scenario tend to move? Well, in this case, the system identified that as a 79 pip objective. Yes, you can go for bigger targets if you prefer. For example, the extended targets, you can customize that to the previous level of support as you become more experienced with your trading. But otherwise, the starts target 79 pips and a 1% profit on that trading opportunity. The Nikkei also giving us a short on the 15th of August. Really nice opportunity there, 1.7% profit on the Nikkei, and it's pretty much held off those levels as well. So that's turned out to be, really nice target or an objective on that trade, 1.7%. Crude oil. Do you know what? Crude oil has been so weird. We've barely had trades for months, it seems. And then we had a short trade there. It's a massive grind higher. No snipers anyway there. No snipers even here on this chopping around. Indecisive, very much so on UK oil. That's Brent crude there. So eventually we got a short trade here, 15th of August. That gave us a 1.87% or 1.9% profit of 120 cents, a $1.20 move. Really nice trade there as well. The Dow, 15th of August, again giving us a nice short, hitting that starter target, 75 points, 1.1% profit. And then finally, for the Tuesday trades, going through to US oils and NYMEX crude oil, that giving us a 1.3% profit there, and again 120 cents or $1.2 on that short trade. And again, a nice take profit because the markets hit that level, stopped, and then started to come back the other way. So the starter target's doing the business for us, hitting those objectives before the markets have an opportunity then to reverse. And then finally, a couple of other opportunities actually from the 17th of August. There's 3 trades we had there. Let's go through those in turn. One loser, one invalid trade, one winner. Let's talk about them. So Aussie yen, first of all, we'll start with the good. That was a nice short trade there. Again, the market chopping around, moving back up after we hit that target, that green line there, hitting the support level there and hitting our profit, 30 pips, around a 0.8% profit. Aussie New Zealand, again, short, brief stop loss, less than 40 pips, 30.4. Do you see that there where my cursor is? That's not enough. We need more leeway. The market's got to chop around, give it itself a chance to get to that target. The pattern is that if for forex trades, if that stop loss is less than 40 pips, it tends to produce losing trades. That's why we have that in there. Therefore, our traders, our members, are nowhere near this opportunity, which, as it turned out, would have turned out to be a loss-making trade. So again, the system, the strategy, steering us to the more likely to be profitable trades and away from those higher risk opportunities too. And then finally, leaving on a loser, which is probably not the way to do it, but getting chopped out a little bit there on pound against the dollar for a 47 pip loss, 2% loss on pound against the US dollar. Add all those up and it's a net profit of around 6.3%, which that's a good week. Hey, if we could do that every week, we'd be laughing all day long, all week long or month long, whatever it is you want to look at it that way. So some really nice opportunities there. August is a really interesting time, actually. You know, people think, oh, maybe not a lot going on. Actually, there can be lower volumes, but that doesn't mean there aren't fantastic moves that take place. You've only got to look at the S&Ps when we showed it earlier, significant falls taking shape on those US indices, on the currency markets at the moment, really making it a very, very attractive time for trading. So overall, good markets at the moment, and hope you're sharing in some great results too. That's pretty much it from us for this week's podcast. Hope you've enjoyed today's session, and we wish you, and Jerry wishes you, of course, every success with your trading. So until next time, goodbye.